Hey everyone, welcome back. Today we're doing a deep dive on real estate investing. But with a twist, we're going to be focusing on avoiding over-leveraging.
Huh.
Taking on too much debt. We found this fascinating article about Warren Buffett and, Donald Trump's business practices, and it's got some great insights on how to avoid some common financial pitfalls.
Yeah, it's pretty fascinating. Even decades ago, Buffett was warning people about the dangers of over-leveraging, especially in real estate. And he was particularly critical of some of Trump's approach.
Yeah, from what I read, Trump would often inflate the value of his properties, like way inflate them, just to secure bigger loans, which obviously led to some pretty sticky situations.
Yeah, like that's a recipe for disaster,
Yeah.
right? Especially if the market takes a dip.
Totally. It makes you realize how important it is to really understand the risks involved. It's not just about the potential gains.
For sure. It's all about understanding your risk tolerance and not putting yourself in a position where you're super vulnerable. Think of it like this. Leverage. It's a double-edged sword. It can boost your gains, sure, but it can also magnify your losses big time.
So how do you avoid falling into that over-leveraging trap then? Especially with real estate.
Well, that's where things get really interesting. The article talks about some alternative real estate investment strategies, ways to get involved without taking on a ton of debt. Have you heard of Arrived?
I have. I've heard the name, but I haven't really looked into it. What makes them different?
So with Arrived, you can invest in shares of rental homes and vacation rentals. It's kind of like owning a tiny piece of a property, but you don't have to be a landlord.
So no huge loans, no dealing with tenants. Sounds pretty appealing, especially if you want to get into real estate without a ton of risk. But I'm guessing there's a catch, right?
Well, there are always trade-offs. You don't have total control over the property, and your returns depend on how well that rental performs. But for a lot of people, that trade-off is worth it. Less risk, less hassle.
Yeah, I can see that, especially with how unpredictable the market can be. What about for those who want to be a little more hands-on, but still want to avoid over-leveraging?
Well, the article mentioned First National Realty Partners. They go by FNRP. They focus on commercial real estate. And they partner with some big names, like Kroger and Walmart.
So you're not just investing in any old building. You're investing in properties with tenants that are probably going to be more reliable. It seems like a good way to lower the risk.
Exactly. It's all about looking for those built-in safeguards against market swings. FNRP gives accredited investors access to this type of commercial real estate, but without the huge loans that usually come with it.
Makes sense. So maybe instead of trying to be a real estate tycoon overnight, it's better to start with more manageable investments and focus on slow and steady growth.
That's something Buffett really emphasizes. He's all about value and minimizing risk, he once said. And this really stuck with me. This is the cornerstone of our investment philosophy. Never count on making a good sale. Have the purchase price be so attractive that even a mediocre sale gives good results.
That's a great point. It's not just about buying and hoping it goes up in value. It's about getting a good deal from the start.
Exactly. Buying at the right price is crucial for reducing risk, especially in a market where things change all the time.
So for someone just starting out in real estate investing, what's the most important thing for them to keep in mind? Is it just about avoiding over-leveraging at all costs? Or is there more to it?
Well, it's about finding that balance, taking advantage of opportunities, but not putting yourself in a risky situation. It's responsible growth, not just wild speculation.
So research and due diligence are key.
Oh, absolutely. And that's where this article comes in handy. It highlights some really helpful resources. One that caught my eye is called Moby. It provides investment research and insights from a bunch of financial experts, including some former hedge fund analysts.
So they're like, the financial detectives?
Pretty much. They dig deep into market data, trends, individual companies, trying to find those hidden gems.
And the article says Moby's picks have actually outperformed the S&P 500, which is impressive. But I'm always a little skeptical. How do they consistently beat the market like that?
It's good to be skeptical. Remember, past performance doesn't guarantee future results, and there's always risk with investing. But what sets Moby apart is their research process. They focus on finding those undervalued assets, kind of like Buffett.
So they're not just chasing the latest fads, they're looking for solid, long-term investments.
Yeah, exactly. Companies or assets with good fundamentals. The potential for steady growth, even if the market hasn't caught on yet.
I see. It's all about understanding value, managing risk, and being patient.
That's it. And speaking of thoughtful approaches, the article also talks about Public. It's a community-driven investment platform.
Oh, Yeah, public. It's like a social network for investors, right?
Yeah, you got it. What I find interesting is that users can share investment ideas and learn from each other.
So instead of just relying on experts, you can get insights from a whole community.
Exactly. It's like democratizing access to information, making investing more collaborative. It's a great way to get different perspectives.
Yeah.
And avoid some common mistakes.
It's like having a support system for investors.
Exactly.
That's pretty cool. But let's get back to over-leveraging for a sec and the potential consequences. The article mentioned Buffett estimated Trump's debts were way higher than the value of his assets.
Oh, yeah. That's a big point. It's not just about how much debt you have. It's about the relationship between that debt and what your assets are actually worth.
So if you're over-leveraged, even a small drop in the market can wipe you out.
It can. That's why being conservative with debt is so important, especially in real estate. Don't bet more than you can afford to lose.
Right. It's like playing poker, but with your financial future at stake. You don't want to go all in with a weak hand. And with the economy the way it is, it seems like a lot of people are struggling with debt. The article even mentioned a lot of Americans are worried about missing payments.
It's a valid concern, which is why having a good debt management strategy is crucial.
So what can you do if you're feeling overwhelmed by debt? Are there resources that can help?
There are. The article mentions Credible as a good option for debt consolidation.
Credible. I've heard of them. Don't they help you find personal loans?
They do. They're basically a marketplace, connecting borrowers with different lenders to find the best rates and terms.
So you can compare all your options in one place. That's convenient.
It is, especially if you want to consolidate high-interest debt, like credit card debt, into a lower-interest personal loan. Could save you a lot of money long-term.
Good tip. But even with resources like that, it seems like managing your finances and investments can get complicated.
Oh, it definitely can, especially if you've got a lot going on. That's why the article also suggests getting advice from a financial advisor.
I've always wondered about financial advisors. Are they really worth it? Can't you just manage your own finances?
You can, but a good advisor can provide some serious support, especially with something as complex as real estate investing. They can help you create a personalized financial plan, help you navigate market changes, and avoid making costly mistakes.
So like having a financial coach in your corner.
Exactly. They give you that objective perspective and the expertise you might not have, especially if you're feeling lost or unsure about what to do.
And the article mentioned a website called advisor.com. What's that all about?
Advisor.com is a great way to find an advisor that fits your needs. It's a free service that connects you with advisors in your area who have the experience to help you with real estate investing, retirement planning, debt management, all that good stuff.
Wow. That's really helpful. So it's not just about finding any advisor, it's about finding the right one for you.
Precisely. Just like you wouldn't hire just any contractor to build your house. You don't want to trust your financial future to just anyone.
Makes sense. It seems like having a good financial advisor can make a big difference, especially with real estate investing. But even with all this advice, it all comes down to making smart decisions yourself, right?
It does. Knowledge is power. The more you know,
Yeah.
the better decisions you can make.
The key takeaway is there's no get-rich-quick scheme. It's about being thoughtful, doing your research, and getting advice when you need it.
Yeah, and remember, it's not just about making as much money as possible. It's about building a solid financial foundation for you and your family.
Well said. So as we wrap up, any final thoughts for our listeners?
Absolutely. Don't be afraid to ask questions. Do your research. Take your time. Real estate can be rewarding, but you got to be smart about it.
You know, it's interesting. We talked about Buffett's criticisms of Trump and how a judge even ruled against him in that fraud trial. It really shows that this isn't just a theoretical risk. Over-leveraging can have serious consequences.
No kidding. Financial responsibility is so important.
It's a good reminder for anyone thinking about real estate investing. It's not just about getting rich quick.
Right. It's about building something that lasts.
Okay, so let's recap what we've covered today. First, avoid over-leveraging. Too much debt can really hurt you if things go south.
For sure. And remember, leverage works both ways. It magnifies gains and losses.
Second, explore those alternative real estate strategies, the ones that don't involve mountains of debt. We talked about Arrived and FNRP, but there are plenty of others out there.
Yeah. Find what works best for you, and don't be afraid to think outside the box.
Number 3, remember Buffett's philosophy. Find those undervalued assets. Get a good deal.
Be a value investor, not a gambler.
And last but not least, don't be afraid to get help from a pro.
Yeah, a good financial advisor can be a lifesaver. They can help you come up with a plan, make good decisions, and avoid those big mistakes.
So before we go, one final question for you to think about, knowing all this, about over-leveraging and different ways to invest. How would you approach building your own real estate portfolio, something that fits your goals and your risk tolerance?
Think about it. Do your research.
All right, everyone. That's all the time we have for today's deep dive. We hope you learned something new and feel more confident about making smart decisions. Until next time, keep learning, keep growing, and we'll see you on the next deep dive.